All right, welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker LBTYA, Liberty Global, a company we've covered here on the channel before. It also is somewhat known under LBTYK, that it has a couple different share classes, which we'll definitely get into. Liberty Global is a global provider of telecommunication services, focus around mostly European markets in the UK, as well as Belgium and Ireland, as well as Slovakia, and they used to also provide services in Poland, which we'll get into. We have covered this company on the channel before, and I definitely made some mistakes in my assessments in the previous valuation, so I'm definitely very interested in going over my new assessment of the company overall. Before we do get into that, I will take a look at our watch list in general, which nothing too much to say of note on here. I did notice the AMC has kind of moved upward a little bit since we had already added it to the watch list, which is pretty interesting to see. It's already becoming a little bit better. I'm definitely keeping an eye on that to see if maybe there is a specific point where that could become more appealing to me. Although I did say in my last stream that I thought Paramount was definitely a much safer bet, and that definitely still holds true. But either way, kind of paying attention to that. Also reassessing some of the positions in my own portfolio a little bit, and trying to rethink just how much I want to size different positions moving forward. What with I've been kind of getting my finances personally into a position where I can start to try to plow more money into the market with it now, I think, starting to reach definite levels of fear. Not really bottoming per se. I definitely think we can go much lower in the market with interest rate rises, but I want to be there with cash on hand, putting more money in my portfolio as it goes. So I've been kind of trying to think strategically about future purchases moving forward. So with that, we will get straight into the valuation, but I did also kind of want to comment. Obviously, we did have the Federal Reserve meeting, which did indeed raise the interest rate, the benchmark interest rate, up 75 basis points, as was expected. And that kind of correlates with what I was just saying. Definitely trying to rethink my portfolio, what with expected interest rates with that. I had definitely been talking about how I expect the interest rates to keep moving up over time, at least for a little bit much further. A lot the expectations that we were basically going to get this last rise this time, and then effectively speaking, that was basically going to be it for the year. And then we were going to maybe get like one more next year, and that was going to basically be all of the interest rate hikes. I definitely thought was a little silly of a perspective. So it seems like most people have come around to the idea that we'll have these higher interest rates all throughout next year, at least sort of a minimum. But anyway, so enough kind of thinking about that. We'll get straight into the valuation today. I definitely don't want to dawdle too much with this valuation today. Hopefully I can keep it relatively short, short as far as our generally at least 45-minute long streams. But anyway, so the company Liberty Global, at least the more recent public iteration of it, was founded in 2004. Technically, the company goes back to the mid 90s in its original iterations. It is incorporated in the United States, regardless of the fact that, like I said, it is a European company, and it does report its cash flows in USD, regardless of the fact that it does have quite a lot of European currency influence. I do have all of its major websites listed here. Current CEO is Michael Fries, who was elected to CEO in 2005, approximately when the company was becoming its new, more modern iteration of itself. And he had previously been part of international operations, the original international expansion for the company. As I already kind of mentioned, it is part of the telecom services industry. I didn't really get into specifics as far as customers, competitors, and suppliers, because frankly, they're extremely varied all across the board in basically all three categories. Suppliers not really much of a relevant one, but like they have a very, very wide, varied set of competitors. Not to mention they're not necessarily super recognizable or super relevant names per se when dealing with the industry for itself. And the customers as well, that's just a huge pile of things. No major customers to speak of. Reporting date, the next reported date is expected in early November, and we can assume that the call and the filing will come at approximately the same time. They're not really providing a top level revenue guidance that I could find, but they did provide kind of comments about guidance by segment for them, and basically all the categories they were providing low single digit revenue growth guidance. So basically you can assume that across the board it's going to be low single digit revenue growth, and that's after the rebasing of the selling of their Poland operations, which we'll get into some of the details for that. Beyond that, they did provide much more specific guidance, which is something that we're going to be relying on pretty significantly when making our assumptions in the actual valuation, which is that they are saying that they expect to have this year in 2022 about 1.7 billion in distributable free cash flow. And it's important that we understand what they mean by distributable free cash flow, which means that they're actually probably meaning something much closer to what I use for my free cash flows in my valuations, which is free cash flow to equity, which is taking what most people think of as free cash flows and then subtracting out or adding to additions of new debt issuance as well as debt pay down. So basically it's free cash flows, but then you take the debt into account and it becomes basically just the cash flows that only belong to the equity shareholder. And so distributable free cash flow is effectively a very similar term. For example, we recently valued Enterprise Products pipeline company, and they use a very similar term. It's very much sort of like their estimate of what they think they can pay out to shareholders. So that's, I think it's really neat that they're doing that because it's very close to the metric I like to use. So we're gonna, like I said, rely on that number pretty significantly at 1.7 billion that they're guiding for. There is revenue guidance from analysts on Yahoo. I found 7.15 billion is the revenue expectation for, according to 8 analysts in 2022, and then 6.99 billion according to 8 analysts for 2023. And then there was unfortunately much less guidance for the EPS numbers according to the analysts on Yahoo, but one analyst had guided for a negative $1.83 cents in EPS, adjusted EPS for 2022. And then 3 analysts guided for an average of a negative 4 cents for 2023, which is very interesting. But we're also going to be relying on those in tandem with the free cash flow estimates that we had. So the EPS negative numbers as well as the positive free cash flow numbers that the company provided us. So it's going to be basically the 2 numbers we're going to use to come up with our shorter term margin assumptions, and which I'll get into in a little bit. They do not pay out a dividend either in the past or in forward. They do, however, have a pretty significant buyback program in place, which is to say that they have kind of an ongoing buyback program currently where they are authorized and relatively committed to buying back about 10% of their share count per year, according to the level of the share count at the start of the year, which for this year, they have already basically completed that. And then they actually decided to throw another 400 million onto the total for the year, bringing the total payout for the year to 1.7 billion, which incidentally is totally in line with their distributable free cash flow numbers. And so basically, if you take that into account, that means the amount that they have left approximately is somewhere about 6.5% of buyback authorization that they currently have in place. And then, like I said, we have a sort of a guidance assumption of about 10% per year that we can maybe assume that they'll be doing based off of what they've currently are saying they're doing, though obviously people can change their minds. The insider held count for the company is 3.83% of total share count, and that's increased by a little under 1% over the last 6 months. So there is some insider holding, and there has been increasing in the last few months, which is pretty nice to see. Not a very dramatic increase, however. Most of the company is held by institutions, 96% of the company or so. Less than 1% of the outstanding shares is short. However, as a percentage of the float, it does become closer to 3% because we do actually have a decent amount of the shares off float due to the class B shares, which I guess now that I'm talking about that, I might as well describe it. I had mentioned a little bit earlier that there is 3 share classes. There's A shares, the B shares, and the C shares, which are the other ones that are primarily traded are the A's and the C shares, which the C shares are labeled LBTYK, just if anybody's wondering about that. And the difference between these 3 shares is that the LBTYA A shares are effectively normal shares, while the B shares have 10 votes per share, and then a much smaller share count of them, and that basically allows for the original runners of the company to maintain voting power. In fact, about 40% of the share count is controlled by the share count. 40% of the vote count is controlled by the current chairman of the board of the company. So that just gives you an idea of that. And there is a conversion factor for the B shares to transform into A shares at a 1 per rate, which would allow for that voting class to disappear over time, probably when those shares are then distributed to maybe an heir or something like that over time. Now the K shares, the C shares, they actually have no voting power, but still have earning power rights, which is pretty interesting to see because, for example, if you pull up the 2 share classes, you can find that the C shares, the K shares, are actually trading at a slight premium to the A shares, which in my mind doesn't really fully make sense considering voting rights should typically give the premium to the shares. So I was kind of curious about the details of why that. I was wondering if maybe it had to do with the fact that the B shares are convertible into A shares and not into C shares, But either way, it doesn't quite make sense to me, because either way, it ends up being pooled into the same amount of total voting and buying power. Now, when it deals with multiple share counts and in my own valuations, what I personally do is I just add up all of the total share counts together and then divide it in, effectively treating all of the different share types as one share type. So for the value of my company that I come up with here, effectively speaking, that value kind of applies to both share types, at which point you might as well just buy the one that has the lower price, because like I said, you're not really going to actually have a strong votable power, because 40% of the vote power is controlled by one person, the chairman of the board. So in a certain sense, the A shares and the C shares actually aren't all that different, because even though the A shares do have voting power, they can't even really use that voting power in the first place. So anyway, kind of moving past that. Now the short ratio is 3.15 days. So that basically means that at current volume levels, the shorts have to have 3 days of current volume levels that would be required for them to cover their shares, which is not a very dramatic amount of time. So the shorts are no particular worry. And like I said, there isn't a huge amount of them in the first place. The average 3-month volume has been 1.3 million shares and per day, and the 10-day average volume has been 1.74 million shares per day. So the volumes have actually been a little bit elevated in the last 2 weeks relative to the last 3 months. Man, I keep wiping my face. I have cat hair all over my face. If anybody's wondering why I keep doing this, because my cat. But anyway, so we will go ahead and get straight into some of the segmentation details of the company. I did have the presentation for the company up, but there's not really too much specific details I really want to talk about in that particular. We already talked about the distributable I keep doing that. Distributable cash flows, and the only other thing they talk about is much more like specific details to subscribership and churn in the company. And I'm going to be honest, I'm actually not really going to dive into a lot of the specific details of the operations of the company. I'm really doing a very simplistic top-down evaluation of the numbers, mostly because this company had a pretty interesting amount of interest in a lot of value investor circles, and I was kind of curious to see where things kind of laid out with it. Being that it's a telecom company and operates in multiple different jurisdictions with different regulatory apparatuses, regardless of the value that I find here, it's not necessarily a company I'm super interested in getting involved in. I'm a little bit jaded personally on my own experience with very complicated companies of this nature in the past, and I kind of tend a little bit more towards a preference of some more simplistic business models that don't have quite as much complication in them. Personally, that's just my own opinion on the business model. But anyway. So for the company itself, I am putting them as part of the global telecom service industry, global in particular, because of the fact that they obviously are, like I said, operating in the European services, but that does give us a more accurate representation of their operation metrics. The unlevered beta that I have for them is 0.63, and the sales capital expectation is 0.76 for the last 3 years on average, according to our data set, and then the average adjusted margin is 9.3%. Which is pretty interesting details. Both of those are going to be pretty relevant to some of the details that we get into the company, because the company itself deviates pretty significantly from both sales capital ratio and adjusted margins in significant ways, and gross margins as well, but we won't get into that. Now, in my previous valuation of the company, I didn't layer down the specific geographies that the company operated in, and then built my ERP based off of that. But because of the fact that they have changed off of they've discontinued their Poland operations, and they haven't put out the new 10K yet, because we're only halfway through the year. I haven't adjusted the ERP in an effective way that I can be super certain of. And so really, I'm just going to do a simplistic method of doing it halfway between the US ERP and the global ERP, which gets me to a weighted country risk premium of 4.75. My previous country risk premium in the previous valuation a year ago was 4.69. And so I've allowed for it to move up slightly, but like I said, the discontinuation of the Poland operations would have allowed for it to move down. And so generally I would have assumed it would have moved up more than 6 basis points. So maybe it would have moved up 50 basis points, but then with the discontinuation of the Poland operations might have brought it down pretty significantly. So this estimation, I think, worked pretty well in the short run, considering we're doing this off base of the 10K, and they've significantly changed their assets of operations and the revenue distribution over literally just the last year. I did see somebody commented there, "Hey man, how's it going?" Buddy in there in the Twitch chat. I don't think I've seen you in the chat before. Welcome to the channel. Subscribe if you're not already. Anyway, after adjusting for the current ratio in the most recent year, that brings their new ERP for the current valuation up to 6.42. And that itself compares to the ERP in the previous valuation of 6.34. So we are at least significantly increasing it on that basis. Now, the unlevered beta of 0.63 is adjusted by the debt to equity ratio of 217%, which includes both their debt and lease liabilities, which come in at a weighted average interest rate of about 5.25% and a weighted average maturity of about 7 years. So they have a pretty decent amount of years to operate on their debt, and not the worst interest rate, not the greatest either, but not necessarily too terrible either. But either way, like I said, pretty significant compared to their market cap, 217%. That brings the levered beta up to 1.82, which brings their total cost of equity up to 15.39%. And then the cost of capital ends up being 7.81% once we weigh their debt in. So now we can get into the specifics of the financial operations they've had for the last 10 years, which is pretty interesting, kind of up and down as far as total operations go. But with the fact that they've kind of made expansions in their business into certain nations over the 10-year period, and then over the last couple of years they've discontinued some of those operations. So it's been a little bit of a complicated volatile process as far as like the total operations go, but going from 9.9 billion in 2012 up to 10.3 billion in 2021. For the first 5 years, it came in at a compounded rate of about 2 to 3% per year, and then for the next 5 years it was actually more like a negative 5 to 6%. So kind of exemplifying what I was saying before, where they kind of grew in their revenues pretty significantly, having taken on specific new operations, and then over the next few years, then they would eventually discontinue those operations. Now, taking a look at their gross margin, that's one thing that I found very interesting about this company, is that they have managed to have pretty high sustained gross margins throughout the entire time frame, though they also changed what with the operations of the business. You can see when they had a huge jump in revenue between 2013 and 2014. The gross margins shifted pretty significantly from this kind of like mid 60s average up to this like mid upper 70s kind of level up in this time frame. For the first 5 years on average, however, it did end up being about 71 to 72% for the gross margins. And then it's ended at 70 to 71% as well for the next 5 years, but the next 5 years on average it was about 72%. So you can see for the entire 10-year time frame, still about 72%, pretty much consistently. So yeah, we had some high years, 77, 78% at the high, 62 to 63% in the low in 2013. But it's actually much more stable in the next 5 years. But overall, for the 10-year time frame, it's pretty consistently in this kind of 70s level gross margins. And the interesting thing to note about that is just how significant those gross margins actually are relative to their competition. If we look at the data set that I put together over the last weekend that I was talking about in my most recent valuation, going down to the telecom services line in, oh wait, I'm in the sales capital ratio tab, my bad. Come over to the gross margins tab and look at the telecom services. You can see for the last 3 years, it averaged 55 to 56%, 55 to 56% for the 5-year average as well. So basically kind of it's consistently about the 55% range. Admittedly, this data set is built around the US markets and not the global data set. So it could be a little bit different from that, but if anything, I would expect the global margins to likely be a little bit lower on that. I do eventually plan on putting together another spreadsheet for this same data set, but the global version of it. I just haven't quite gotten around to that. It'll probably be another weekend here at some point. But either way, the point is you can see 70s gross margin compared to mid 50s gross margin for the industry expectation. That's showing very strong competitive position in their overall pricing. So maybe yes, they have been a little bit volatile in their choices of bringing on revenues and assets and operations into their business, and then the kind of an almost temperamental attitude about getting rid of them might seem a little strange, but they've managed to at least maintain the pricing throughout the process. Coming down to their net margins, that's another interesting thing to pay attention to. We'll come down to the adjusted net margin. You can see that they're kind of doing single digits net margins, also several years in negative net margins for the first few years, and then also kind of ending in 2016 at 12%. For the first 5 years on average, it basically was about a margin of 0% if you're averaging them all together. And then we have a little bit of a chaotic situation as far as net margins go, what with the discontinuation of operations we were talking about, because of the way that they recognize some of those charges in their accounting statement. It made their profits seem extraordinarily large and extraordinarily small in certain years in the last 5 years. So that's how you end up with negative 25% margin in 2017 and 100% plus margin in 2019, 100% plus margin in 2021, and then negative 14% margin in 2020. It's like, well, those aren't really super representative of the actual profit that those companies are having those years. It's really just a matter of gap recognitions of things. If we're looking at the average over the entire time frame, it ends up being about 20%, which isn't necessarily the most representative way to do it. Another way that we can do it, which I'll actually do relatively simple right here, is we can actually do more of an aggregated thing, and it might come out being very similar, but maybe not. The aggregated net income for the 10 years was about 20 billion. And then we can take a look at the aggregated revenue for those 10 years as well, and then compare those two numbers, and that might give us a more representative idea of what the average net income was for the 10-year time frame, taking out all of the weird volatility in place. And that ends up being about 15 to 16%, as you can see right here. So 15 to 16%. Now, here, I'm going to do it again. Let's compare that to the industrial expectations. I mean, I already talked about the industrial expectation a little bit when I was talking about the segmentation. It comes out of being about 9.8%. We can come out to telecom services in here at 9.3%. And that's the 5-year average. You can see the 3-year average is 6.6%, 9.3% for the 5-year average, 8.9% for the 8-year average. So it's like being generous, we'll say 9.3% for the 5-year average. Again, this is the US data set, not the global data set, but that's not that far off, relatively speaking. And again, I would think it would tend relatively lower. The US tends to be more profitable. So we can see that they have sustainably high gross margins across the 10-year time frame, and sustainably high net margins once you smooth out all of the complications, the profit losses in several years, and then unsustainably high profits in other years. So anyway, coming down to the cash flows, you can see how this actually comes down to once we actually adjust all these things back down into kind of more normal cash flows, as well as taking all of these discontinuation of operations and adjusting that into a more normalized sense of reinvestment as well. In fact, we'll take a look at the reinvestment a little bit more specifically. The adjusted net capex line, which I have right here, is the number that I like to think of as a total sense of reinvestment. It includes capital expenditures, depreciation and amortization, changeovers, working capital, R&D and its amortization, if that's a thing that exists, as well as acquisitions, if that's a thing that exists, all boiled up into one number so you can get an idea of what the total reinvestment's like in 1 year. For the first 5 years of our historic time frame, on average, they had reinvestment of negative 1.4 billion. So they were actually disinvesting about 1.4 billion in assets per year for those 5 years. And then for the next 5 years, it averaged negative 445 million. So they've still been discontinuing their assets, but about half a billion or so per year, and about a third as much as the first 5 years. And so really, they haven't been reinvesting at all. This has been a company that's been effectively pulling cash out of the business rather than reinvesting in the business, and it's effectively had much higher cash flows than its net incomes as a result of that. In fact, if we think of the net incomes in here, it'd be 2 billion or so on average is what it ends up being, and then the cash flows that they had available to the company ends up being more like 3 billion, though this is after debt issuances as well. And if you look in here, debt issuances actually ended up being about 50 million per year. So really, it's actually close to netted zero in the debt issuance or so. And then the free cash flow to equity ends up being 3 billion, which shows that they've disinvested about 1 billion or so per year. Anyway, so I'll take a look at the free cash flow to equity from another perspective. For the first 5 years, it averaged 2.4 or 2.5 billion. And then the total amount of cash flow that they paid out to the shareholders on average ended up being about 1.6 billion. So they definitely weren't overpaying their shareholders for the first 5-year period. The next 5-year period, they averaged about 3.5 billion per year in total cash flows that they could pay out to their shareholder. And then the amount that they did pay out to their shareholders ended up being about 2.1, 2.2 billion or so. So still not overpaying the shareholders. They've been massively ramping up their share repurchases. These share repurchases have been accelerating or so over the whole time frame. And as we talked about, they have plans in place for pretty highly accelerated levels of free cash flow to be returned in the form of share repurchases. But that seems to be not outside of the bounds of expected cash flows for the company. So that's pretty good and what we would like to see. So coming down a little bit further, we can take a look at their returns on invested capital, which is a metric we like to see about the total operations of the business, which is one interesting thing to see, or especially considering they had such volatile earnings across varying years. So taking a look at this over a longer term time frame is a little bit curious to see. It is interesting to see that even with the negative profit years that we had in the first 5 years of our historic time frame, they do end up with positive returns on invested capital, relatively speaking, because the returns on invested capital aren't quite the net income that you use. So it's usually lying a little bit higher up in that. So we still at least end up with in positive territory. For the full 10-year time frame, the average returns on invested capital ended up being about 9%. For the last 5 years or so, it's been more like 14 to 15% or so. And you can see returns on equity are significantly higher than that, with the returns on equity for the 10 years being about 82% and then about 47% for the last 5 years or so. Coming down to the balance sheet, we can take a look at their total assets to see what they've got to support the operations of the business. Total amount of cash on hand for the first 5 years on average is about 1.5, 1.6 billion. which is interesting to see that they've actually kind of had a little bit of a downward move in cash, at least in the most recent end of the most recent year. The average for the 5-year period was 2.7 billion, so that was a little bit of an elevation relative to the first 5 years, though it's a little bit thrown off by the outlier of the 8 billion on hand in 2019. But they ended 2020 or 2021 with less than a billion in total cash on hand. But that doesn't take into account the total amount of cash that they've also generated in the last 6 months, which has actually been relatively significant. Though they do also have a significant amount of marketable securities, which they're going to basically consider like cash, so to speak. I'm just not necessarily doing the same for that. Looking at their receivables, you can see that they've actually done a good job of lowering the receivables over time, 1.8 billion being the average for the first 5-year time frame, and then for the next 5 years it's been 1.2 billion, and then ending at less than a billion or so. Comparing that to their accounts payables, you can see that they had an average of 1.2 billion in payables for the first 5-year period, and then it's been less than a billion for the next 5 years, and then ending at less than 900 million or so. So they went from having more payables than receivables in the first 5-year period to getting their payables and receivables under control and well managed at this point. Or not really well managed, but at least to a respectable level, a sort of base minimal level. That's what you want to see, having more than the other. In total current assets, if we look at that as well, 4.7 billion as an average for the first 5 years, and then averaging about 6.1 billion, 6.2 billion for the next 5 years, ending at 5.9 billion. And you can compare that to the current liabilities of an average of 8 billion or so for the first 5-year period. So you can see that there was definitely a lot of liabilities relative to their total current assets in the first 5-year period. And then the next 5 years, it was 7.5 billion. So still a bit elevated as far as the total amounts were going on the total average, but it's thrown off by a few of the years in the first part of it, and then it ends at 4 billion in current liabilities. And again, that's relative to the almost 6 billion they have currently. So you can see that their current assets to current liabilities, their working capital, was a mess 10 years ago, and it was a mess 5 years ago. But they've improved in the last 3 years. It's much more where how we like to see a working capital setup, much more well distributed the overall levels between them into, at least, like I said, a considered liquid company, a company that can actually afford to pay its bills and it actually has the assets on hand appropriately. Also, taking a look at their total assets, you can see that as something that has moved just about as chaotically as the revenues have had. You can see for the first 5 years, on average, it was about 63 billion or so in assets they had, and then for the next 5 years, it was 53 billion or so, and then we've ended at 47 billion or so in the most recent year ending. And then comparing that to the total liabilities, they had 52 billion in the first 5-year period, so they at least did have positive equity, despite the fact that their current assets and current liabilities had such issues. The larger statement of the balance sheet at least was in a better position, and then that compares to the 40.6 billion that they had in the next 5 years, so a decrease in liabilities in line with the decrease in assets that we saw for them, and then that ended at 21.3 compared to the 46.9. So the ratio improved on that basis as well. And then that in and of itself can be seen in the equity statement as well. I was saying that at least they had positive equity in the first 5-year period, but what they didn't have was retained earnings. They just had a lot of capital that had been contributed to the company, and that capital has been slowly paid back by the company through the forms of buybacks and retaining of earnings over the 10-year time frame. And then their retained earnings is also turned around as well, going from negative territory for the first 5-year period up to massively positive territory, which puts them in the position to do more of those buybacks in the future, because the shareholders' equity has also effectively exploded over time. So now coming down, we can take a look at their sales capital ratio, which was one of the things that I thought was pretty curious about the company, how this kind of diverges from a lot of the other things that I've said about the company. I've talked about how good the gross margins have been relative to their industry, how good their net margins have been relative to their industry, how good the returns of invested capital have been, how high their debt has been, but how great of the progression of their balance sheet has been over the 10-year time frame. It's like their balance sheet is still not really great. It's still, pretty messy and has a lot of debt on it, but they went from like a total basket case balance sheet to at least a managed balance sheet, which means that the discontinuation of operations has been a success, effectively speaking. But what is interesting, because like I said, this is in relation to the sales capital ratio, is that the sales capital ratio, you would almost not be able to tell that anything necessarily happening. And I usually, so usually you can find significant changes in operations in the sales capital ratio, because if they have a huge changeover in their sales, that's going to pump up the numerator. If they discontinue a huge amount of assets, that's going to change the denominator. And you can see that, yeah, it shifts over time, 0.33, 0.26, up 0.3 again, down to the twos, up to the threes, almost to 0.4, and then down to the twos. But it still kind of stays in this relatively low range. And the thing that's interesting is how low it is relative to the industrial expectation of 0.76. Now, I did point out that their net margin is so high relative to the industrial expectations, and I've also talked pretty regularly about how usually when you see a low sales capital ratio, you might often see a high net margin, or if you see a low net margin, you might see a high sales capital ratio. There's often a balancing act between these two metrics in companies. Not necessarily. Sometimes it goes, and there are exceptions. Sometimes there's a company that's excellent in both categories, but then they probably are overvalued because everybody knows it. Or there's a company that can be poor in both categories. Like, for example, you can see here that the industry as a whole is not super great in both categories. I would say 9.3 is not a terrible margin, technically speaking, because like usually when I'm talking about high or low for these metrics, I'm usually saying a sales capital ratio of 1 and a margin of 10%, I think is a good point between low and high. So 9.3 is just below that line, so to speak. So you could say this is more like a medium margin and low sales capital ratio. So, but either way, the industry is not great, is the point. But you can see the fact that they end up having such a low sales capital ratio is interesting to me comparative to their industrial expectation. And like I said, it does make sense considering the fact that they have such a high profitability. That means that there's a trade-off that they've made in their operations over time, which is to say that they're willing to invest lots of capital if it means they get to keep high returns on that capital, which is what they've gotten. But the fact that they, like I said, it has managed to be so steady regardless of the changeover in their business, that's the part that I found a little bit fascinating. The fact that it's just steady Eddie. So anyway, but we will get into the projections for the company specifically in the future of the company. Like I said, I'm not doing anything super specific as far as projections of revenues and different segmentations and paying attention to subscribers and things like that. I'm keeping it relatively simple in my assumptions and really just kind of relying on the analyst assumptions as well as the guidance provided by the company, as well as certain details having to do with their comparative strengths over the 10-year history, as we talked about, like the gross margins and the net margins, as we'll get into. But one thing that I am kind of specifically doing to tailor this evaluation to be a little bit more specific is that I kind of made a special adjustment to the revenue basing, which is that I multiplied the revenue base by 0.69 so that it would basically come down to about 7.1 billion, which puts it in line with the expectations of the Yahoo analysts had for 2022, which is about 7.1 billion or 1.5 billion or so. And my expected number ends up being about 7.2 billion. And that's because they discontinued their operations. And I didn't want to put the trailing 12-month year here. I just wanted to put the fiscal 2021 number. So I kind of had to make that special adjustment to make the rest of the valuation work out appropriately. So we kind of based down to the new revenue base that they're at. And then from that point on, I have it growing at anywhere from negative 10% to positive 10%, leaning towards 2%, which is basically flat. But I do have it also, the probabilities significantly leaning towards the more optimistic model. I have 30% in the fourth more optimistic model versus 10% in the second more pessimistic model. So on an overall basis, the trend of growth is going to be a slight upward revenue growth, low single digit revenue growth after the rebasing effect. So we're going to go from 7.2 billion in 2022 numbers or so up to maybe about 7.7 billion in 2027. And then like that part, you could argue maybe I'm being actually a little bit rosy for them on that end of it, but that kind of goes in line with some other assumptions I have in place for here too. Now, I also talked about the EPS estimates that the analysts have put in place for the next year or two, that there's a negative $1.83 for the next year, but that there's only one analyst that's in place for that. And then a negative 4 cents for next year with 3 analysts projecting for that. Relatively low numbers of analysts talking about it, but the fact that they seem to be in a solid agreement that there's going to be negative earnings this year and next year, or at least agreement next year. This year, there's not really agreement. It's just the one dude. But the point is it's generally thought of that there's going to be excess discontinuation costs that's going to hit their GAAP earnings, but that it's not going to hit their cash flows. Because as the company had already talked about, that was another thing the company had guided, is that they expect to have distributable cash flows of 1.7 billion. So I needed to come up with a set of
assumptions built into this valuation that would give us both GAAP losses in the short term, but also positive cash flows in the short term. And so with those assumptions in place, basically what I did is I kind of automatically modified. I used the 9-year average of the net margin as my base, which effectively was about 20% or so. But then I multiplied that by negative 0.25 to get basically around a negative 5% or so, which is going to get me around a negative 1 to 2% in the 2022 period, which gets me approximately negative 14 cents per share, based off of the current share count. That's based off of the current share count. So I at least got to negative EPS. Like I said, it's not nearly as large of a negative EPS as the $1.83, but I got to negative EPS with these assumptions, which I'm fine with. I'm fine with that at least. And then I also relied on like I said, the sales capital ratio. I'm basically going to allow it to stay basically around the same level it's currently at, maybe drifting slightly upward on expected basis. It looks like it's going to stay basically the same level, about 0.24. Like I had said before, it seems like their sales capital ratio stays pretty consistent in the same range. It doesn't really shift too consistently. You might argue that since 2.5 is around the lower end of the range, it could move up over time, but they're discontinuing operations. And so I don't really think they're going to get the best pricing on that. So in my opinion, the sales is likely to go down at a faster rate than the capital is going to go down. And so overall, I think that staying in the same range makes sense. And so overall, that's my assumption for that. And then I'm also making large assumptions of how much debt that they're going to use for the company on an expected basis. I'm assuming that they're basically going to stay in basically the same range of the debt to equity ratio, approximately 200 and change percent or so relative to the market cap. And if you use those assumptions in place altogether, that gets me to a free cash flow to equity, which means free cash flow that belongs to equity shareholders, not debt shareholders. You have to take out the debt portion, in the next year of 1.1 billion or so. So I have the negative EPS, and then I have positive free cash flows to equity. It's not 1.7 billion as the company has said, it's 1.1 billion. But I decided that I was, like I said, because of the way that my template kind of smooths between the current numbers and the future assumptions that I have for the company, I'm not really too concerned with what 1 year looks like. I'm more concerned with what the averages of something looks like. And so really, I just want the average free cash flows to equity for my 5-year period to be approximately in that 1.7 billion range. Because then that means that that's in line with what the company said that they plan to do. Because not only do they plan to have 1.7 billion to pay out free cash flow distributable this year, but they plan to do 10% of their market cap next year and the year after that, according to their current plans, which is approximately in the same range of at least 1.4 billion, because that was what the number was before they added the extra amount that they did this year. So with the free cash flow to equity starting at 1.1 billion, but then moving upward towards my terminal margins, which I'll get into the assumptions of that in a moment. Eventually, I end up at 2.3, 2.4 billion for that, but the average for the 5-year period ends up being about 1.7 billion. So that's why I ended up with the assumptions I did, is like kind of was trying to work myself into this at the end. Like I wanted to eventually end up with these numbers, and I had to put the assumptions in place that kind of worked myself backwards to those assumptions. Now, for the actual assumptions for the end net margin, that was something I came up with independently of that. And that is based off of my assumptions, based off of the margin that they currently had relative to their industry, which is to say, if you look here, the average gross margin that the company has had for the 10-year time frame is about 72%, and the average net income margin the company has had has been about 20%, and the ratio between that is about 3.5, 3.6. Now, the average gross margin for their industry has been 55.7% for the last 5 years on average. And then the average adjusted net margin for the industry has been 9.3 for the last 5 years on average. Now, the ratio between those two numbers is 6. And then the ratio between those two ratios is 1.66. So I then took the margin itself, the industrial margin, which is 9.33, and multiplied that by this ratio of 1.66. And that gets me to a margin of 15.46. So that is the margin that I said that they could have in the future, which means that they basically have the same ratio of excess margins above their industrial expectations 5 years from now that they currently have. And so that's kind of how I ended up with the margin I have here. I then chose a range of 8 to 20% and had it lean towards 16%. And with the probabilities that I already had chosen in place for the revenues, that got me to an expected net margin of 15.43%, which I said was close enough. That's basically exactly where I wanted it to be. So those are how I came up with my margin assumptions as well as my debt and capital assumptions, which then made me work backwards into my free cash flow assumptions. So I'm basically relying, like I said, on the analyst assumptions, the company's own guidance, as well as my database of industrial expectations, and the assumption that this company is going to maintain a gross margin advantage over their competition as they've had in the past. And all those assumptions together ends up with the valuation I have effectively in place. I do then adjust the company for a pretty significant amount of default risk that the company has. This comes off the back that the total amount of interest that they pay on their debt is huge relative to the amount of money that they have prior to paying their interest. Which is to say that, for example, on an expected basis, in 5 years, I would expect them to be paying about $1.3 billion per year in interest, even though the total amount of EPS profit that I expect them to have is going to be about 1.2 billion. So you see, it's a huge amount of interest relative to the profit that's being paid out to the equity shareholders. And again, you can think of interest as the profit that gets paid to the debt shareholders, right? So effectively speaking, the ratio between the net income and the interest paid is like a ratio between the profit paid to the debt holders and the profit paid to the equity shareholders. And you would really hope that the equity shareholders are getting a larger amount of profit. So if that doesn't show you that there is a significant amount of debt and a different significant amount of debt risk involved, then that, I don't know what else will. And as another thing that I've kind of commented on in a lot of my valuations recently is that it has to be understood that this debt assumption is not necessarily an assumption that they might go bankrupt. It's an assumption that the credit markets themselves might not really be available when the company needs it, which means that they may not be able to do things that they might want to do for operations of the business, and that's going to affect their value. So it's a different understanding of like what we're doing here. It's not me saying that there's a 4 to 5% chance that the company goes bankrupt and disappears from the face of the earth. It's a 4 to 5% chance that the company defaults on a credit obligation and has to renegotiate terms, which then has spiraling effects on the rest of the operations of the company. So anyway, that's basically gonna do it for the assumptions of the valuation, and we can come over to our final summary page. Before I do the final summary and description of the total valuation, I will say, if you're watching at this point, either live or on the replay, please give us a like. It would be very much appreciated. More likes helps attract more people to the channel. And if you're liking and you haven't subscribed to the channel already, please subscribe to the channel. Whether you're watching live or on replay, please subscribe. It'll make sure that you get notifications whenever I go live, as well as notifications for any other content I happen to put out. And if you haven't already, in the pinned comment in the chat, as well as the in the description below, is the link to the Discord. Join the Discord and you can be part of the conversations that we have there about daily news, details surrounding our own portfolios, analysis of companies, as well as the actions of major investors in the markets. So come be a part of the discussion there. So anyway, LBTYA, Liberty Global, Class A shares, although like I said, this valuation effectively works for both the Class A and the Class C shares. It's technically sort of a weighted average between the two, because like I said, I'm really just adding all the total share count together. And they do trade at a slight difference in cost. So effectively speaking, if you're going to rely on my valuation, I would say just buy whichever one is the cheaper shares, which right now is the A class shares. Because like I had also mentioned, the B class shares are the ones that effectively control the votership. So the fact that the Class C shares don't have voter rights doesn't really make a difference, currently speaking. That wouldn't necessarily be the case in the future, though, if the B shares were to fully convert into Class A shares. But anyway, I digress. Current U.S. Treasury selling for 3.71% as of the end of the market yesterday. Equity risk premium I have for mature markets is 5.73%. And the discount rate I come up with for Liberty specifically, after adjusting for company specific risks, is 15.38%. They do not pay a cash dividend. 5 years ago, they had sales of 13.7 billion or so, and in the most recent year, it was 10.3 billion, which comes to sales growth of negative 5.5% per year or so. The sales capital ratio that they currently have is 0.25 relative to their industrial expectations of 0.76, so pretty low sales capital ratio relative to their industrial expectations. And again, a sales capital ratio is the sales that they have relative to their capital base, which tells us how much revenue they have for each dollar of capital that they invest in the business. Returns on invested capital on average has been about 14.42% or so for the last several years or so. And then the debt to equity ratio is currently about 217%. the default risk in the most recent year. I actually did not adjust the most recent year or so. So we can basically just kind of ignore that detail. I forgot to adjust that now that I'm realizing it. Profit margins in the most recent year was 130%, which, as we kind of talked about, is a little bit of an anomaly due to the fact that they were discontinuing operations, and so they had to recognize a huge changeover in GAAP earnings, so it's a little bit of an anomalous number. But either way, they do typically have relatively high profit margins, especially compared to their industrial expectations of 9.3%, as we had kind of talked about a little bit earlier. That profit, though, that ridiculously large profit, 13.4 billion, again, definitely not sustainably thinkable number. They're currently selling for $16.94 per share. The probability distribution that I'm using for the valuation is pretty heavily tilted towards the more optimistic fourth model relative to the more pessimistic second model. I have 30% weighed into this outcome relative to the 10% in the second model. So I'm weighing it this way partially because of the fact that I had rebased the revenues down to the much lower revenues they have after discontinuation, and my uncertainty about just how many more discontinuations that they're going to do. So I wanted to leave a large amount of downside in the revenue potentials, even though I wasn't going to assign a huge amount of probability to those outcomes. So that's basically why I did what I did. But either way, that gives us revenue expectations of anywhere from 4.2 billion in the worst case scenario to possibly 11.4 billion in the best case scenario. And on an expected basis, we see about 7.7 billion. And that gets us sales growth of anywhere from negative 16% per year to possibly positive 2% per year. On an expected basis, we see negative 5 to 6% per year. And then sales to capital ratio, we're assuming it'll stay basically in the same range, about 0.24 or so. And then the returns on invested capital, we do expect to basically collapse dramatically down way below their cost of capital, down to 3.75%, which is to say that, effectively speaking, they had really large returns on invested capital for the last several years, but much of that came off of the back of good pricing off of their discontinuations and being able to return that capital to shareholders effectively and efficiently. But as they start to close out the discontinuation process and return back into more of a steady state of an operational business, there isn't really going to be strong returns, and definitely not above their cost of capital. Is too mature for that, and too low in competitive spacing, even relative to their good competitive margin spacing. Debt to equity ratio on expected basis, we do see about 196 to 197%. So we see it coming down a little bit, partially off the back of market cap adjustment, but overall we expect them to stay at pretty high elevated levels of debt to equity. And off of the back of that, we see a pretty significant amount of default risk, about 4.5% per year or so. So that's about a 4.5% chance per year that they're going to default on their debt. Now, again, that doesn't necessarily mean that the company goes bankrupt. That just means that there's going to be some complications in credit markets that could affect other things, but it may not mean that they go bankrupt. It might just mean that they have to do a fire sale of some other assets or something like that. But the point is it's going to affect their value. So we do trim off the value in that way. Profit margins, I have a distribution of anywhere from 8% to 20%, leaning towards 16%, which gets us an expected number of about 15.43%. And I gave my kind of explanations and methodologies for how I came to rely on that number earlier. And that gets us a profit distribution of anywhere from 336 million in the worst case scenario to possibly 2.2 to 2.3 billion in the best case scenario. On expected basis, we see about 1.2 billion or so. And using these profit outcomes and the discount rates that we've applied across the varying outcomes here, that gets us to an expected present value price of $16.97 per share, which is basically the current share price, give or take a couple pennies. We have 5-year forward value targets, unadjusted for any dividends that they could choose to pay out during the time frame, of anywhere from $14.96 per share in the worst case scenario to possibly $83.86 per share in the best case scenario. On an expected basis, we see $34.70 per share, which, if you compare that to the current share price of $16.94 per share, that gets you an implied return of 15.42% each year for the next 5 years or so on a compounded basis. Pretty decent absolute returns to be had. Those absolute returns, however, are basically in line with its discount rate, which means that there isn't really that great of risk-adjusted returns. Effectively, you would just be getting the market return adjusted for risk if you were to buy it at this price, so to speak. And it's definitely not really the greatest return relative to other opportunities in the market. And also not really a great distribution of worst case to best case scenarios necessarily across varying models, as well as across the the qualitative factors of the company, which kind of brings it into the value score that I have for the company of 0.6, which is not terrible, but definitely not in very good territory at all. Well below the idea of perhaps buying the index, which, for example, if we come over to our watch list, we can see how it does indeed stack up. We come over here. Here is Liberty. You can see it fits between other companies like, say, Alibaba and Foot Locker, or perhaps Invesco or Biogen. It kind of fits in that spacing in my watch list of companies, with, for example, the S&P 500 being at 0.72 of a value score, and one standard deviation and above, which I think is a good metric for what counts as high value scores, being companies way up here of anywhere from IMAX Technologies all the way up to Zoom Integrated Shipping, and the 10 or 12 or so that kind of fall into this best in class category. So that's basically going to do it for Liberty Global. Happy to have updated the valuation, which, like I said, changed pretty dramatically comparative to my previous valuation that I did of the company about a year ago, which is to say that I really didn't account very well for the discontinuation of operations in the previous valuation, and I didn't really take into account how those things would play into the future assumptions. And I also relied much more on the idea that they would return to an industrial expectation in the future in my previous valuation, rather than relying on the idea that they might actually maintain some sort of position relative to the industry as they have had historically. So with that, for example, like I had much lower margin assumptions, even though I had higher sales capital ratio assumptions, and I had left their sales much higher and had not adjusted for the discontinuations in the previous valuation. And the rest of the assumptions are relatively in a similar ballpark, so to speak, although I had also assumed that their debt levels would drop pretty dramatically. And as a result of that, the valuation was actually much lower. The current valuation, being that it's about fair value, is a significant improvement from what I had valued them previously. So like I said, I definitely think there was mistakes that I had made in that previous valuation a year ago, but you live and learn. So that's going to do it for the stream today. The next stream planned is on next Tuesday, as we typically do. The company that I'm planning to cover for that valuation currently is AMD. I've kind of been working on that one a little bit in the backdrop a little bit. I'm looking for other suggestions of companies to value, however, before the Thursday stream, but for all other streams thereafter. So if you've got suggestions of other companies that you would like to see me value, that you think are possibly a good value or of interest to lots of other investors, you can comment them in the chat, in the comments below. You can come and join the Discord and share them with the group. So yeah, one last call and cry. It is the pinned comment in the chat as well as in the description below. Please come and join the Discord. Please like the stream before you go. Please subscribe to the channel.